Good morning. Good morning to everybody. Apologies for that. Just having slight internet struggles, but I think we're back on track. Thank you to Baron and team. Thank you for the invite. This is my second session with you guys, and today we're going to tackle employee benefits. I've entitled this Employee Benefits 101 because we're really going to go through the basics. This is quite a complex area, but this is just to set the foundation of employee benefits. Okay, so I think the first question we should all ask is, what exactly are employee benefits? There's a lot of confusion around these terms. There's group schemes, there's employee benefits, retirement benefits, pensions, providence, and the list goes on. So employee benefits can be grouped into four main groups. If we look at the benefits that are offered to employees, they can be things like medical aid, they can be group life cover, group disability cover. We call these risk benefits. And of course, there's the retirement benefits that are attached to employee benefits. It's important to understand that these can be taken in any combination. They can be taken together or they can be taken separately. So just to unpack those four earlier benefits, we're going to start with the medical aid. So what is group medical aid? So it's basically a monthly payment towards a medical plan. So we all know that in South Africa, it's not that we have bad medical services, but we have medical services that can't cope with the demand. So there is a very big private sector, and to access that private sector, it's quite expensive. So plans, they offer access to all of these treatments, these surgeries, this private hospitalization. And it goes on with things that they would refer to as day-to-day benefits, where they have things like optometry and dental, where you could go and see anyone on the private side as well. So with group medical aids, they do become more affordable than if individual go out and get it. There's a lot of companies out there that have plans suited for companies where they have, in most cases, more than 5 members that are much more affordable than your traditional medical aids. Now, there's a big thing on tax savings on medical aids or on medical aid contributions. So once a year, when you do your tax return, depending on the amount of money you earn, you'll have to do a tax return to SARS. Most medical aids can claim a deduction for dependence on the plan. So if we look at the current tax year, when you do your returns for this year, taxpayers can claim a deduction of 347 Rand for the first 2 dependents and then 234 Rand for the second 2 dependents. So when you receive your IRPs, you would see the medical aid contributions, or you'd receive a medical aid certificate, which you will submit to SARS. And effectively what they do is they're going to pay you back that money. So it is something that government would offer to take the pressure off themselves, essentially, by allowing you to pay for your own medical. And just on a little side note, there's the national health insurance that's being talked about a lot. This is a plan that's been used and I think we're modeling ours after the UK. So national health insurance is not going to replace medical aids. That's a misconception. There's still going to be a very big need. National health insurance will give you access to certain facilities and doctors, and it's going to take a very long time for them to implement that. So if there's anybody out there that's waiting, I would suggest having something in the interim. Okay, then we move on to group life cover. So group life cover is essentially an insurance benefit that pays out a fixed sum to beneficiaries. So any individuals untimely passing. This is important because once we leave the earth, we leave a whole lot of, in many cases, we leave a whole lot of debt. And the thing about creditors is they don't respect death. They will come after the surviving members of the family. So in order to negate this or get past this, what it's advisable to do is to have some sort of group life cover in place. When this pays out, it's not necessarily to enrich those you leave behind, but it's to ensure that they can maintain their standard of living. Very simple case would be to pay off any bonds that you might have, to pay for kids' education, things like that. There. So when we planning for these life events, it's important to take all of that to understand, okay, how much a cover should I take out? In terms of a group life cover, it works, how they calculate it is, it works on multiples of your annual salary. For example, we put a little example there. If a person's earning 100,000 per annum and he's covered for 3 times his annual salary, that life cover will pay out a lump sum of 300,000. When we talk about all of these group covers, in most instances, employees will contribute a portion towards the life cover. In terms of individuals that do not have a group life cover, there are options to take out individual life covers. For business owners, this goes into things like buy and sell agreements. Very slowly, I'll just touch a little bit on that. Especially if you have partners in business. If one partner passes away, you don't particularly want that partner's family, who might not have the expertise, to come and join into the business. So what they would do is they would have what they call a buy and sell agreement. If that partner passes out, there'll be a life cover portion that's paid to the company that will then be paid to the family to essentially buy the shares. So that's the different forms of life cover. But as I started off by saying, is we're going to keep this as simple as possible, and we can also always delve into this at a later stage. Okay, then we have group disability cover. This is another risk cover. And this is an insurance benefit that will pay out a fixed sum to you if you're permanently unable to work. So this is due to an illness or injury. So the amount is intended to replace any future earnings that you might lose. Bearing in mind, if you work with your hands, and in our case here, if you're in the plumbing industry, you can't do that any longer, you'll have to replace that income in some sort of way. This as well is also calculated on multiples of annual salary. So similar example, if a person is earning 100,000 per annum and they covered for 2 times their annual salary, they will pay out a lump sum of 200,000 rand. Now, these are the 2 major risk benefits that you would have with any group cover, and traditionally, most companies would choose life and disability. There's other covers that we didn't necessarily cover in this, and you have things like critical illness, where they would cover you for things like the different cancers, for heart conditions, etc. Now, those are very expensive covers, and if you're doing it as a company, as a group, you've got to have the buy-in of all of your employees and employers, because those become very specific, and not everybody might feel that they have a need for covers like that. Right, then we move on to the group retirement benefits, pension and provident benefits. So in terms of group retirement now, these terms, pension and provident, have been with us for a very long time. I think it's the most common referred to as a pension plan. But it's important to understand the difference between all the words as well. You have pension, you have provident, and you have retirement annuities. So, just in a nutshell, if we combine all of these, that's a retirement savings plan where contributions are based on a fixed percentage of monthly salary. So, when you're structuring group benefits, well, you would pay a risk-rated percentage for your risk benefits, meaning that they will take the company as a whole. They will look at the ages, they will look at the genders, they look at the income. These are all risk rating factors. And then they will calculate and tell you, okay, fine, your life cover is going to cost you 0.5% per 100 Rand. So that's how they'd work out the premiums for your life cover and the premiums for your disability cover. The balance of that money, which could range between any percentage that we put in the range bracket, they would be used to go towards a pension fund. So the pension fund can be paid by both the employer and the employee. And this would go towards savings towards your retirement. The thing about these is they're very structured, and you will not have access to any pension benefits or provident benefits or retirement benefits until you reach certain ages. Now, having said that, there are out clauses, if you want to call it that, on any contracts. So if you below certain levels, for example, if your savings are below 25,000, you're allowed to take that out as cash. If you had the traditional provident funds, you're allowed one withdrawal on the provident fund, which you can take before retirement. The idea of these funds is to force people to save towards retirement, because if we look at our retirement statistics, we have very, very few people that can actually afford to retire. The figure ranges between 6 and 8% of total South Africans that can afford to actually retire, which means that we have a very large portion that actually don't save towards retirement. And it's extremely important. While we cover ourselves for events like death and disability, we often forget about the retirement portion. If you put it into context, if a standard individual retires at the age of 65, and that individual has to live up to the age of 85, that's 20 years that they need to provide an income for. So retirement contributions are paid out as a 1/3 lump sum, and they're paid out only at retirement, and the balance is used to purchase a pension or to provide the employer an income during retirement. So this is, now we're going to discuss this a bit later now. It's the new way. So in 2021, what government decided is that they're going to do away with the provident funds. So the provident funds paid out the entire amount. The individual was allowed at retirement, they could take out the entire amount, or before retirement, they had the one withdrawal. And what they found is that a lot of people take out all of their money and then they don't have any money to invest. The pension fund, on the other hand, would pay out 1/3 of the value at retirement as cash. So the idea there being to settle up any debts that an individual might have, and the balance of the 2/3 was used to purchase a pension or annuity. So when we use those words, what we basically mean is that the balance was used to provide an income. And a very, very simple calculation is if you're receiving close to 10% return on your money and you have R1 million, that's only going to provide you with 100,000 Rand, which equates to just under 10,000 Rand income a month. So it gives you an idea of how much you really need to save. So if you take your lifestyle and you need to survive on 50,000 Rand a month, bearing in mind that you would have probably paid off all your big debts and like your bonds, etc. at retirement, then you know you're going to need a ballpark figure of around 5 million Rand in terms of savings. They're very scary figures, but they're very true figures, and this is where we've got to change our mindset, and we've got to start contributing a lot more towards our retirement. So we use these words: the pension, the provident, retirement annuity. So retirement annuities are more individual-based products, and they work exactly like pension funds. So what government has now said is, all right, in March 2021, they changed all of the rules for pension and provident funds, and they said that everything will be the same. Essentially, you're going to only be allowed to take out one third as a lump sum, and then the balance of that money you'll take out as an annuity. Now, pension and provident schemes have very favorable tax rates. Just quickly, for example, the first 500,000 Rand is tax-free for pension funds. So when you get time to that big lump sum payouts, there is a sliding scale where the first couple of million is taxed quite favorably, and then the tax becomes a bit higher after that. Okay, we can unfortunately never escape the tax man. So now the big thing with retirement contributions is there's a very big tax savings contribution. So government has acknowledged that they can't afford. If you consider the government pension right now, if you didn't have anything in place, it's I think around 2,000 Rand, just over the 2,000 Rand mark for this year. It's not easy to get access to that there, and not everybody can afford to survive on 2,000 Rand a month. So what they've done in turn is they said, okay, fine, if you start contributing to your retirement contributions, we'll give you a tax savings on that contributions. So how this works is they take, let's take an individual that's earning 100,000 and they pay 18,000 Rand tax. So essentially for the year, they would pay 18,000 Rand in tax. Now, if that individual contributed 10% of their earnings to a group retirement scheme, they're no longer taxed on the 100,000. So they will be now taxed on 100,000 less the 10% of the 100,000, which would be 10,000 Rand. So they essentially now taxed on 90,000 worth of income. So the tax payable is the 90,000 times the 18%, which is 16,200. So essentially, from originally contributing 18,000 Rand, they now contribute essentially paying 18,000 Rand in tax, they now pay 16,200. That 1,800 Rand is the actual tax savings. And if you want to put it in another way, you'd say that the retirement contributions are partly funded by government. So this is where government gives you a bit of an incentive to save towards retirement. That and the fact that at retirement, all of your contributions will be taxed very differently. They're not taxed at your marginal rate of tax. Okay, so we did touch on this earlier. So we said only about 6% of South Africans can actually afford to retire and be fully independent. The rest has to unfortunately depend on family members or the state pension. And at the bottom there, you see the pension figure. So this is what the current pension figure is, 2,030 Rand per month. And sorry, yeah, one more thing I didn't touch on is that with the advances in medicine, we find that people are living a lot longer. So when all of these scales and figures were done and all of the analysts looked at this, they had a lifespan of about 72. And you will see, and I'm sure you'll see in your personal surroundings as well, people are living past that 72 age. And they're living into their 80s. We have people living into their 90s. So we've got to plan accordingly for things like that. All right, now when we look at group schemes versus personal insurance, so everything you can do in group schemes, you can do as an individual. So without any group risk, product underwriting is performed on a group. So what that basically means is in a company, they take the entire group and then they look at those risk factors I mentioned earlier, where they look at the age, they look at the gender, they look at the income of the individual, and then they offer group cover based on that there. So technically, they do not go and test every individual. Whereas if you go for your personal assurance, every individual is underwritten. So they look at your smoker status, they would look at your lifestyle, and then they would send you for a series of tests before they say, okay, fine, we're happy to cover you for X amount. Whereas in a group, they don't do all of that. They underwrite you as a group. They take the risk on the group, which means essentially that individuals can qualify for a lot cheaper cover. And okay, unofficially, it means that somebody who might have had an underlying issue can sometimes not be picked up, and they actually score in terms of life cover that they would get there. They also have what they call a free cover limit. And a free cover limit is an amount of cover that each employee of the scheme qualifies for without providing any medical information. So if you take a company, they would look at all the risk factors and they'll say, okay, fine, we're willing to offer this company a free cover limit of R1 million, which means that everybody earning under R1 million automatically qualifies for the cover. Everybody over R1 million, they would ask a few questions, and based on those questions, if they feel they need to send the individuals for further testing, they will do that before they take on the cover, and those individuals might get different rates. An example there would be if they found an individual with high blood pressure, somebody earning above the R1 million rate, so it didn't qualify for the free cover limit. They would then send that individual for further testing, and if they pick up a heart condition, they might load those premiums. However, that first R1 million he still qualifies for that at the rate of the company. So group schemes essentially are very affordable. They do come in at much better rates than individual rates do. Okay. I think time is nearly up. So in conclusion, employee benefits help us take care of our loved ones. So remember, any insurance product is not specifically designed for us. It's actually designed to take care of our lifestyle and those around us in the event of death, disability, and retirement. They are much cheaper. They're much more affordable benefits than individuals buying their personal capacities. And they also help companies with staff retention. As business owners, especially now with the economic times we're going through, a lot of people are looking for security. And as a business owner, I think staff retention is always number one, the number one thing to think about for your work. And benefits like these help retain staff. And they're not necessarily expensive benefits, because a lot of people would look at employee benefits and say, oh no, I can't put this into place because it's going to take away about 10% of our salaries. There are other options out there where we call them, for example, off-the-shelf products. Just to give you a very quick example, there's a company, Sanlam, I'm sure the majority of you, they have an entry-level product which would start at 268 Rand. It gives him like 20,000 life cover, 20,000 disability, 15,000 funeral cover, and pension contribution. So in terms of affordability, it's not just, okay, let's just close the door into employee benefits. It's about going out there. I'm sorry, I just used Sanlam as an example. There's other companies with very similar products as well. We call these off-the-shelf products, and it's something to start off employee benefits. So if any one of you is thinking about it, if you'll know of your companies that are thinking about it, it's always nice to start the discussions with employees. In terms of the contributions, these can be structured in many, many ways. You can have it where the company contributes a portion and the individual contributes portion. In most cases, 90% of the times, it's a 50% company and a 50% employee contribution. can be structured in the reverse, where the company says, okay, we want to pay for all the benefits. Or it can be such that the employees say, okay, fine, we want the benefits and we're willing to pay for it. So there's various ways of structuring employee benefits, and they really are important benefits to have. Okay, and that brings me to the end of my presentation. Thanks, Byron. Is there any questions?
Thank you very much. We currently do not have any questions, so we'll give it for the seconds just to see if there are any. But thank you very much for joining us this morning. I think people can take away a lot from this. Is there any last-minute words you'd like to add?
No, just the usual. If anybody needs any assistance or advice on anything, this is what we do. We specialize in this. They are welcome to contact us, and we'll assist them from there.
All right. Thank you very much. Thank you, ladies and gentlemen, for joining us this morning.